I'm looking forward to a great panel. So the topic, as you can see, is evolution of decentralized exchange. I'll share a couple of thoughts to frame things up, and then I'll turn it over to Cam to present on some of his research, and then Brian and Lee, and we'll take it from there. In terms of myself, I'm Troy Paredes. I'm moderating the panel. I'm my own consulting advisory firm. I've been a Securities and Exchange Commission commissioner prior to that. Prior to that, I was a professor of corporate and securities law, and even before that, I was a corporate and securities lawyer. So I've had the chance to think about these issues from a variety of different perspectives over the years. And one of the things I think is so interesting about the topic, and really looking forward to hearing what Professor Harvey has to share, is when you think about decentralized exchange, I think there are two overarching questions from my perspective that come to mind. One is when you start thinking about markets, kind of from a first principles bottom-up perspective, what makes markets work? What makes markets not work as well? What are the goals and the objectives? So that question is front and center. It's a big question. The second big question front and center is, how do you craft an appropriate regulatory regime? When one thinks about so many of the things we encounter through our professional lives or day-to-day in our personal lives, the regulatory regimes have been constructed and have been constructed for some time. The regulatory particulars may change, and they do change through the legislative process, the regulatory process, the enforcement prosecution process as well. But not often do you have as much need or room to try to figure out, well, from even a construct perspective, framework perspective, what ought the regulatory regime to look like? And that then, of course, has to marry up with how we think about what the marketplace ought to be when it comes to its fundamental structure and design. So I think it's a really interesting, unique opportunity. And of course, once you get that all in place, which is no easy thing to do, lots of different views on that, then you do have to start getting into, of course, all of the details and the particulars. And what is, I think, as an aspect of that, then I'll hand it over to Professor Harvey, I think also very interesting for me, given my background in policy and regulation and law and all that sort of stuff, is that much of regulation and the regulatory regime is say, okay, well, we have these entities and we regulate these entities, which we often call, intermediaries, broker-dealers or exchanges or transfer agents, if one's thinking about it from a financial services perspective. That is a regulatory construct which has been adapted to a more centralized, if you will, marketplace. Once you have a more decentralized marketplace, then it challenges the regulatory construct that's been put in place, because then the question becomes, well, wait a minute, if we regulate, say, broker-dealers, who's the broker-dealer? If we regulate exchanges, well, where is the exchange? If we regulate issuers, well, who exactly is the issuer? So all of that sort of stuff is front and center. I think fascinating. It really is the heart of the policy debates that are going on, which of course have a direct connection to what the business place and the marketplace opportunities are. So with that, by way of putting some thoughts on the table to get the ball rolling, let me turn it over to Professor Harvey. You want to give maybe 30 seconds on your background, and then it would be great to hear your thoughts.
So I'm professor of finance at Duke University, and I've been in this space about 10 years. So I've taught a course on crypto over the last 10 years. I'm also co-author of the book DeFi and the Future of Finance, and a Coursera certificate. Okay, so I like the way you set it up. We've got a regulatory construct, and I think one of the fundamental issues that we have to deal with is this innovation that we're living through. Does it fit the construct? So I think a lot of the issues are regulators trying to shoehorn something that's completely different into a legacy construct. And that causes a lot of uncertainty and potentially some regulatory mistakes. So I'm going to talk about some research that is co-authored with Joel and Fahad, and just to kind of set the discussion going forward. And there's no slide advance. That would help. That doesn't help. Okay. Yeah, so this is some research that was sponsored by Wharton. It's unusual research for me, well, actually for all three of us, in that there's no hypothesis that we're testing. So a lot of this was to try to understand what's going on in terms of the evolution of decentralized exchange and to kind of inform the discussion as to how we think about a regulatory approach for decentralized finance and decentralized exchange in general. So we've heard a lot about decentralized exchange yesterday, and we kind of went through maximal extracted value, or EV for short, and some of the issues with that. Indeed, we heard that all MEV is bad. So what I'd like to do is to kind of set this up, talk about some of the benefits and some of the risks of decentralized exchange, and what are the possible options going forward in terms of regulation. So there's obvious benefits to this technology in that we've got reasonably stable liquidity 24/7, that we can liquefy illiquid assets. And indeed, people working on this technology, even outside of blockchain, to have kind of centralized DEX, which seems like a contradiction in terms, but you just set up like an automated market maker for illiquid asset. So it is a good idea. And in terms of the quality of execution, it's pretty good in liquid pools. Indeed, very competitive with centralized exchange. So this is like a very good idea, but there are some downsides to it. So maybe, yeah. So we talked about MEV, and this is one of the issues. Okay, so think of this as front running, sandwich, back running. All of this is potentially costly in terms of the quality of execution. So for me, what you want is the highest quality execution. And this is complicated by the reordering and adding transactions that builders can actually do. So this is an issue, and certainly things like front running, use that word. It's a hot word for regulators. And in our paper, we kind of detailed the difference between front running in the equity context, where it just doesn't make any sense. You send an order to your broker and the broker front runs you. No, you can't do that. Whereas in decentralized exchange, everybody can see all of the orders in the mempool. So it's a different construct, but nevertheless, it degrades the execution. And what we are really concerned about is the quality of execution. Okay, so there are many possible solutions, and we talked about some of these yesterday. So things that exist right now, like MEV Share and MEV Blocker, are mechanisms to kind of improve the execution quality by, let's say, rebating by, let's say, with MEV Blocker, like a back run. So I will admit that when I started this, I thought back runs were irrelevant because it happens after the trade. But no, if the trade moves the price too much, that's just low quality execution. So if you give somebody the right to back run that and then rebate some of the price degradation, that improves the quality of execution. And that's really what we care about. Okay, so there's, again, a lot of research going on here. And I think that things will improve. It's kind of interesting the way the space unfolds. It's like just try stuff. It is cheap to try stuff, and something will work. And I do think that we're focusing on the right problems right now. And in the end, I see that the quality of execution will increase. Okay, so let's talk about some of the issues beyond MEV. So one issue is sanctioned addresses. Okay, so this is a big deal for regulators. And you could set up a decentralized exchange. People could be trading on that exchange that you don't want them even in the space. So think about the people doing ransomware. And there's many well-known addresses for that. So you don't really want them in this system. But what do you do? Okay, it's a very difficult problem. Indeed, you could think of having a list of these sanctioned addresses, and then you could have, I guess, a Uniswap v4 hook that says, you know, you only these are the addresses that you can transact, or maybe exclude certain addresses. But the problem is that people could go somewhere else. Right? And indeed, you could even have like a builder not accepting transactions, like to go into a block if there's a sanctioned address. But the problem is that there will exist at least one builder that will put it in. So it's really difficult to deal with this. On top of that, the list of sanctioned addresses is not updated that often. And we know how easy it is to create an address. So this is just a really difficult problem. So in terms of oversight, I guess the question is, like, how do we even think about regulation in this space? So there's 5 basic approaches. So number 1 is to regulate the users of these protocols. And I think that that's kind of a backwards approach. If you think about the 1933 Securities Act, it was motivated to protect the users or the investors. So to go and sanction the users doesn't make any sense to me, at least. Number 2, you could just ban DEX trading, but that is problematic because let's say the US does that. Well, there's many other countries in the world that, like, you can deploy a DEX from anywhere. This is a decentralized technology. So one country could do something, but it's not clear how effective it would be. Indeed, everybody's got a VPN. Okay, number 3, you could go after, let's say, the lab that supports a DEX. And indeed, we've seen this with Uniswap being served with a Wells notice. And I think this is really problematic too, because the lab is supporting the technology. Like, indeed, it's improving the experience for the user, patching problems, new versions. So to go after the lab is really like a backwards approach. It is not well thought out. And indeed, to me, it really shows a lack of understanding on the part of certain regulators. Number 4 is an idea floated that given that centralized exchanges could be using decentralized exchanges, the centralized exchange, which could be fully regulated, might provide some vetting of certain decentralized exchanges. So you get kind of like an indirect approach So think of certain decentralized exchanges as being certified. And then number 5 is something that I think plays out all the time in decentralized finance, and that's self-mitigation. And I think that we're seeing this in real time. It was mentioned yesterday that the sandwich attacks are not as popular today as even last year. There was this hilarious interview, I'm not sure you saw it, with Jerry, Jarry. So Jerry is like an anonymous person, but runs, Jared from Subway, and which is a sandwich shop, right? And he was very careful not to identify himself, and for good reason, that this is likely market manipulation. Okay, so like even the people doing this stuff, I think, are hesitant because of some regulatory clampdown. But more generally, we're addressing some of these issues in terms of MEV mitigation and things like that. The sanctioned addresses, that's really hard to deal with that. Okay, so let me finish up and let me just kind of reflect on the issue with regulation in this space. So I look at it this way, that the regulator has a very difficult job. They're working with legacy regulations from the 1930s, before computers, and they need to balance. And if you talk to regulators, or at least good regulators, they understand this balance. That if you're too harsh in the regulations, then the innovation goes offshore. And no country wants to lose their best ideas to another country. But if you're too lenient, then there could be certain people taken advantage of. So that's like the balancing act that they face. Number 2, this technology is complex. Okay, it is challenging to understand. And the regulator needs to invest time in actually understanding this technology, and they're busy. Like even to teach this material is very frustrating because whatever you taught last year, 50% is out of date. Okay, so think of it this way: even if the regulator invests the time to really do a deep dive in this technology, the depreciation rate is 50%. You need to go back to school effectively every year. So very, very difficult to do. And then finally, it's just really hard to recruit high quality people into the regulatory complex, especially in this space. Got other opportunities. So that's kind of where we are in this paper, to think about the different approaches. The ideal approach, I think, is the self-mitigation. I don't think that's going to be good enough. The regulators want to do something. And again, you see what Europe has done with MiCA. It says very little about decentralized finance. It's more focused on centralized finance. So our challenge is decentralized finance. What do you do, given that something will be done? What is the right approach for the regulator? So that is the key question in our paper. So I'll leave it at that.
Thank you. Awesome. I appreciate it, Professor. Brian, why don't you give 30 seconds on your background and share some thoughts.
I'm Brian Nistler, General Counsel of the Uniswap Foundation. Uniswap Foundation is many things to many people, but especially for this context, like I think everyone should just be aware that we want to give you grants to do research about the things that Cam was talking about. Like these are real cutting edge issues. There is no clear answer to this. Like MEV is a relatively new thing, and you can't. I have to talk louder.
Is your mic on?
Check to see if it's on.
No, it's not on. Yeah, there we go.
How's that, guys? Better? Wonderful. These are new questions that are being asked. We're on the cutting edge of regulation in this space. There is no DeFi regulation even on the table right now. MiCA doesn't address it. Every single legislation put forward in the US Congress deals with stablecoins or centralized finance. There has been proposals for registration of validators, of block builders, of the sequencers themselves, but no one really has a full answer to this. And from my perspective, and I am biased, these open and permissionless systems should stay as open and as permissionless as we can allow for them to.
Lee?
Hi, everybody. I'm Lee Schneider. I'm the general counsel at Ava Labs. We work on the Avalanche protocol, among many other things. I definitely want to visit Jerry's sandwich shop because they must make delicious hoagies. So I'll be heading there after lunch today. As Cam said, right, when you try to teach this class, it's 50% new learning. Imagine what it's like for us lawyers who are dealing with it day in and day out, and everything is constantly changing. The key problem here is, I'm going to articulate what Cam said in a little bit different way and a more in the way that lawyers might think about it, is we just don't have good ways under the law of thinking about autonomously functioning code. And really that's what DeFi is. I would exhort everyone here to come up with the definition of decentralization that you think is the right definition when you're thinking about DeFi and other issues around decentralization. There have been many, many papers written by intergovernmental agencies, regulators, et cetera, et cetera. They all talk about DeFi. None of them define decentralization. And frankly, none of them define DeFi. DeFi is a misnomer. DeFi suggests that what is being traded are all financial instruments. And that is not the case. Any asset that has been tokenized can trade in a DeFi protocol. It could be a financial instrument, but it could also be some kind of meme coin. Everybody knows what meme coins are. Do I need to explain that? Okay. It could be some kind of crazy meme coin. And while there are some regulators who confuse meme coins with financial instruments, I think for the most part, normal people recognize that that's ridiculous. And so when you're dealing with markets where everything trades together, it poses, and on top of that, trades on autonomously functioning code. It completely wipes away the regulatory framework that Troy was talking about. And Troy's being way too modest. He is also the author of the best book on securities law. It was originally Louis Loss, then it was Loss and Seligman, and now it's Loss, Seligman, and Paredes. Troy has taken up the mantle there. All of the stuff that's in that book, as much as I hate to tell Troy this, goes out the window because it's autonomously functioning code and all assets are trading together.
So to pick up on, not the downer note about the treatise, but to pick up to pick up on the theme, and then I'll come to you, Cam, and Brian, maybe in that order on this particular question. One of the things that you and I, Lee, have talked about for a long time now is even in terms of the overall regulatory approach, policy approach, enforcement approach, that so much of the effort along the lines of what Cam, you were saying, is the effort to say, all right, we got not just the regulatory construct, the regulatory regime, regulatory framework, but we have what I just referred to always as the regulatory particularities. When you get really detailed about, the nuanced aspects of what constitutes custody for purposes of a broker-dealer custodying a security, right? There's a whole, that's developed over decades and decades without any regard to blockchain technology. But there's a whole lore, understanding, rules, regulations, enforcement actions, action letters that have kind of built up the regulatory particularities on that. And you can replicate that across the entirety of financial services regulation and quite frankly, beyond financial services. That then you have the underlying technology and the thing, right? Whatever the thing happens to be. So, all right, how does the thing and the technology, complicated when it's decentralized, fit with the regulatory particularities, and it doesn't fit so well. And so then from a regulatory or a policymaking perspective, you're left with, okay, so what do you do? From an advice and counsel lawyering perspective, you have a similar question. Well, what do you do? Particularly where you're mindful of how the regulators may approach it. So you need to factor all that in, and these things mismatch. And so what's going to give? Big challenge. My view has been, and this is the question, that a different approach, not so original in thought, is to say, all right, instead of starting with the regulatory particularities, let's start with the regulatory objectives. What are the objectives that need to be met that, quite frankly, underpin the 33 Act, the Securities Exchange Act, the Investment Company Act, the Investment Advisors Act, and again, we can take it beyond financial services. And things like addressing conflicts of interest, think about front running, right? Things like addressing conflicts of interest, things like transparency and addressing information asymmetries, right? These are just some of the considerations, without going through the whole laundry list, that are the basic pillars in terms of regulatory goals and objectives that informed and motivated the development of the securities laws as they exist today. And again, you can replicate that. That a useful approach could be to, in some sense, set aside the particularities, think about the objectives in light of the underlying technology, and then come up with a set of regulatory particularities building from the objectives that actually align with the technology, whereby key regulatory objectives can be met that actually are key to well-functioning markets, but it can be tailored to the particularities of the underlying technology as compared to trying to fit the underlying technology into regulatory particularities that in no way contemplated the technology of today. Is that an approach? Is that too big of a lift? Is that pie in the sky?
It's pie in the sky, unfortunately. It's the way that it should work. So what are the objectives? And what we've seen is the regulators first going after centralized entities because they're easy to go after, right? They've got a headquarters, they got the board of directors, a CEO. So it's relatively straightforward to go after them. But to go after an algorithm that's deployed on thousands of nodes, like how do you even think about that? So yeah, ideally, here are our objectives, and then we're going to craft a framework to actually try to achieve these objectives. Yeah, that would be great. But there's so many barriers. And one barrier I mentioned is that you really need to understand the capabilities of this technology and its limitations to actually do that. And I'm afraid that given the complexity, given the lack of understanding, the easier approach is try to shoehorn into what we've got, regulation by enforcement. And it's almost like the objective is that nobody gets ripped off. And that's unrealistic. So if you do that, it means no risk. Just get rid of the whole complex if you can. And that's not the way that we innovate. So in innovation historically, you take risk. And overall, the economy wins. But along the way, there will be some hiccups and some people will lose. That's risk. And if we want expected return, there has to be some risk taking. And in my opinion, the current approach is pretty dysfunctional.
Lee?
My approach to the regulators is fight the man. No, just kidding. No, seriously, these are hard questions. And I think part of the problem that Cam correctly identifies about understanding the technology is that regulators have a level of distrust with the quote unquote industry that stops them from having these positive interactions so that they could really understand what's going on. And look, I'm not saying there are not good reasons for distrust. Yesterday, it was pointed out that Tether's being investigated by the criminal authorities in the US. But it was not pointed out that TD Bank, one of the largest banks in the world, just paid $1.5 billion in fines for money laundering. So regulators sort of like try to make it look like, oh, TradFi is all wine and roses, daisies and unicorns and jelly beans. It's not, right? There's all of these underlying problems taking place, even at the regulated centralized counterparties. So going back to Cam's point about self-mitigation, it's kind of interesting to see that the market responds so quickly to everything that's going on. Like, no offense to all the MEV people, I find most of the MEV stuff just mind-numbingly boring. But what's really interesting to me about it is that there's this constant uptick in innovation of, okay, the MEVers are doing this, so we got to do that. And the MEVers are doing this new thing, so we got to do this new thing, right? And watching that process happen, that to me is the really cool stuff. If regulators could create the conditions, maybe here's more pie in the sky for you. If regulators could create the conditions that really nurture that kind of activity, maybe that's the way that we all benefit the most.
Ryan, from your perspective, yeah, Ryan?
Yeah, on that point, like, I think broadly speaking, having the market solve these issues in innovation is the right approach. A good regulatory framework will understand and adapt to and embrace the market. If you look at the regulatory constructs and type of framework we're trying to set up, and what are we solving for here? We're solving for insider information, we're solving for people front-running trades, and we're solving for transparency. The blockchain is transparent. You can see all activity on it. You can design sequencers and nodes to return MEV back to its users. You can look into Uniswap's liquidity pool and see the levels of liquidity and the band in which you have to trade in it. These are all market solvable problems. There are businesses built out in crypto for analyzing how much token spin there is. Who are getting these tokens? There's Chainalysis, TRM, Elliptic to monitor for transactions. We have built a whole entire industry around compliance in this issue, using the technology as its basis. And any regulatory framework should embrace that technology. And it's a question of, what do you as an individual need to know and understand to feel protected whenever you participate in these markets? And having that transparency and openness is, in my opinion, what you need and require.
Just let me, one thing, you mentioned Tether being investigated. Well, Tether is just an example of a centralized entity, right? It's important in terms of what we do in decentralized finance, but this is just another example of going after centralized, and it is difficult to go after anything decentralized.
So Cam, for decentralized exchange, well, maybe two questions for you that are very much related, and then we'll go Ryan and Lee, but feel free to jump in. In terms from a marketplace, so set aside regulation for a moment, from just a marketplace, market structure, if you will, vantage point, what do you think are the important conditions that need to obtain in order for decentralized exchanges? And I know I'm asking a pretty broad question, but for decentralized exchanges to be successful, is there a particular something where you would say for decentralized exchanges to reach, significant scale and be successful for the long term, not something where you look back in 5 years and say, well, that was kind of interesting, but to have longevity from a marketplace dynamic perspective, what do you think that takes? And then relatedly, what do you think it takes, or what needs to be avoided in terms of regulation and policy as a complement to whatever you think needs to occur for the exchanges to reach what you think their potential is?
So I actually believe that decentralized exchange is successful like right now. So like a massive amount of capital has been transacted on decentralized exchange. And in terms of the overall, it's still small, but consequential. And that's sort of numbers I've seen, 15%, something like that, which is very large compared to, zero, obviously. So for me, I think one of the key things is to get the best possible execution and the lowest possible transactions costs. So the way I see it, when those transactions costs decrease, so think of gas fees going down and the quality of the execution, the MEV being rebated, stuff like that. Once that happens, I think this issue of fragmented liquidity is almost off the table, because all of these decentralized exchanges will be operating as one. So given the way that transactions work, where you can buy on one DEX, sell on another, to put a multi-step transaction together, that you could be tapping liquidity for multiple DEX to kind of reduce price impact. So like in the future, the way I see it is that we will still have centralized exchanges. Decentralized exchange will be much more prominent, that it won't be 15%, it'll be 50%, and maybe going higher. And it's also the case that we will have like a large variety of assets trading. So you think about like the NYSE or NASDAQ, you choose which one to list on. And with decentralized exchange, there's no choice. Anybody can deploy a liquidity pool. So it's completely open. And with the tokenization of almost all assets, there will be this wide variety of decentralized exchanges available for many different assets, all linked together, and no monopoly. So you can have different decentralized exchanges with the same sort of pairs competing against each other. So eventually what we get is what we call the competitive equilibrium, where yes, there will be some rewards for those that actually provide liquidity, but we're going to get a situation where prices are very high quality.
Ron?
I love that Cam just described the concept in crypto of intents, like the intent of what you want to do and how you want to transfer it and how you want it to execute over what several set of exchanges or centralized exchanges. You input your desire to trade into an algorithm, into an AI, into whatever, and it executes the trades within the bounds in which you have set. And intents, I think, are going to be one of the next greatest things in the crypto ecosystem. It will be set by like your standards of, I don't want to give my MEV to these several bots. I don't want to give it to Jared from Subway. I want to have it routed, rebated to myself within this band of trading, and I want to buy Taylor Swift tickets. And that intent is sent through the massive crypto economy, interconnected centralized exchanges and DEXs, and returned to you at the best possible price. And in that way, you are protected. In that way, it is transparent. And in that way, there is, I think, no real regulatory issue or overhang that a regulator can point to and say, you were not protected, it was not transparent.
I love what you just said, Brian, because that's sort of like a dream world for me.
The only thing I would add is I want to be able to tell Siri to do all that stuff so that I don't have to write the computer program for it. Because I'm a lawyer, I don't write computer programs. I think all of these are exactly right. And Cam, I really liked all of the points that you made as well. The one piece that I would add is as all of these different assets are trading in the same markets, we do need to make choices about how we want those markets to look. And the concept of market integrity is one that's talked about in financial instrument trading markets all the time. And that's mostly because those markets have become highly electronic, so it's easier to talk about market integrity because it's easier to see things playing out in real time. And so borrowing some of the market integrity concepts from traditional financial services and incorporating those into the DEXs and other DeFi protocols that are being created, I think provides really good information. The last point I'll make is sort of following on the monopoly point, and as well as on Brian's point, like everybody has different ideas about what they want to do and tolerances for what they want and understanding of what it can happen and how things work. The beauty of decentralized protocols is that if you have an idea, you can create it on the decentralized protocol because nobody's stopping you. Unless you live in certain countries and then they are stopping you. And this is the last point I'll make is we should all be arguing for a free and open internet, because without a free and open internet, blockchains don't work, DeFi doesn't work, and the promise that Cam and Brian and Troy are all articulating never comes to fruition. So we need to also talk to regulators about how they can create the conditions for a free and open internet to let all this stuff happen.
And so we only have a couple of minutes left, but to pick up on that, and maybe we'll work the work the other way. So you mentioned talking to regulators, policymakers, et cetera, about all of this, and a lot of that, of course, is ongoing and has been for some time. Regulators, policymakers, and you see it in speeches, you see it in actions that are taken, you see it in proposals that are made on the regulatory front. And it's in some sense where we started, and it goes back to some of the points that Cam and his co-authors make in the paper, that there are some concerns that regulators, policymakers have, and there are concerns that market participants have as well. And we've touched on some of those today. From a policymaking perspective, if one focuses singularly, and I'm not saying that's the case, but if one focuses singularly on the bad stuff, well, that's going to skew one's perception. Well, we got to make sure we avoid all the bad stuff. The other side of the ledger, which doesn't tell you where anybody comes out in the balancing, is to say, all right, we got to focus on this bad stuff. We got to do it effectively, but we got to make sure we don't give up the good stuff. And maybe we can actually promote the good stuff, not just not lose the good stuff. We can actually promote the good stuff. And now we're trying to do the balancing, and policymaking inherent in that is balancing, is trade-offs. It's just unavoidable. It's just the nature. It's just the nature of it, inherently so. Not challenges, but it's just the nature. You got to make choices, and people make different choices. All of that is the wind-up to say, picking up on the last point you made, Lee. If you were to encapsulate, not esoterically, theoretically, but concretely, for policymakers and regulators and others for that matter who have some concerns, what the benefit is, what the upside is, why people will be better off with this as compared to without this, not to dictate where a policymaker necessarily lands in the balancing, but in a manner that puts something on the other side of the balance to weigh against, okay, but here are my concerns. What's that encapsulation? And we'll work backwards here from you and then Brian and then Cam. What's that encapsulation of, all right, here's the case for, here's the thing that an aspect of this that's going to make people's lives better in the following concrete ways? How do you capture that in a succinct, tangible way?
So I'm going to steal one of Cam's points, frankly. I think the monopoly point is a key point, and I will articulate it slightly differently, though. It's a centralization point. What we have seen over the last 20 years is incredible centralization within financial intermediaries, to the point where we have the biggest big banks being so big that they dwarf everybody else. The fact that we've gone from 10,000 banks in the United States, and now I think the number is less than half that. It's been the same thing for broker dealers over the last 20, 25 years. We're losing a lot of the competitive edge that comes with a huge number of market participants. DeFi and decentralized permissionless blockchains allow us to gain that back, and I think make for a more robust economy.
Brian?
I'm gonna play to my audience here and say, more information we have, the better we can make decisions. And to go off of Lee's point too, the centralization of banks keep information away. It's a competitive edge. You do not know their trade desks. They trade in dark pools. You do not have a complete picture of the market based on trading activity from banks. In crypto, you can see every single transaction that happens. It is available publicly. The more information we can have, the more efficient markets we can create. And I think that is the true benefit of true DeFi. And I do want to distinguish a good point. I think that Cam's hit with it too as well. There is true decentralized finance or asset trading, and there's DeFi in name only. And people will use the moniker of DeFi for centralized services. And in those cases, the regulation is very clear. Regulate those entities. Where we actually have DeFi, open and transparent systems, more information is better.
And Cam will give the last word to you.
Yeah, so it's interesting because when I talk to policymakers and people in Congress or Senate, I make the case for the benefits. And these are bipartisan issues, fundamentally bipartisan. And so things like financial inclusion. So with this technology, your smartphone is your bank. And there are 1.7 billion people in the world that are unbanked and many that are underbanked. So financial inclusion, financial democracy. So there's no institutional investor, retail investor, banker, client. Everybody's the same in this space. And you talk about centralization. Well, what we're doing is providing some competition and fundamentally improving execution, liquidity, things like that. These are all good for economic growth. What isn't good is the system that we've got today that's highly centralized. You mentioned the big banks. Well, it's kind of interesting. If you've got a savings account at one of these big banks, what's the interest rate that you're getting? It's like 2 basis points. So even though rates are around 5%, 2 basis points. The most generous bank is Citibank, and they pay 5 basis points a year in interest. So they're just taking advantage of people. And this is very common. And for example, to invest in private assets, you need to be qualified in the US. So the high school chemistry teacher with a degree in chemistry that's interested in chemtech, following a company, wants to invest in the company, cannot do that because they don't make enough money. I think it's $200,000 a year you need to make to be qualified, and qualification is purely based upon income. So this space opens up the possibilities of, again, financial democracy, where these investments are available to everybody Unfortunately, we don't have the regulatory framework at this point, but in the bottom line for me is growth. So we need to grow as an economy, and there are certain fundamental things that can help that growth, including inclusion, democracy, reducing transactions costs, and things like that.
Well, if you join me in thanking the panelists for this morning's discussion. Excuse me?
Question, ask a question.
I think we're at time, but are we at time?
Yeah.
Yeah, I think we're at time, but if folks are around, I'm sure they're happy to answer any questions. I think there's a short break and then you reconvene in a bit. You need a 15-minute break? Yeah, okay, great. Thanks, everybody.